Today, we are going deep. We're not just looking at a stock, we're literally opening up the professional analyst playbook to show you how it's done. And our case study for this is a really fascinating company that's right at the heart of India's tech scene, E2E Networks. Okay, let's get into it.
So it all boils down to this one question, right? You hear about some hot company, but how does an actual professional investor go from just hearing a name to making a multi-million-dollar decision? Well, it's not a gut feeling. It's a disciplined, step-by-step process of digging in, and that's exactly what we're going to walk through together today. And here's the game plan. We'll start by figuring out what this company actually does. Then, we'll dive straight into the numbers, because that's where the real story is. After that, we'll get to the big question, what's it actually worth? Of course, we have to balance that with a hard look at the risks. And finally, we'll pull it all together into one clear investment thesis.
Right, Section 1. Look, every solid investment starts with a solid analysis. We're building this case from the ground up, using only publicly available stuff. Annual reports, investor calls, analyst notes. The real work is turning all of that raw data into an actual decision.
Okay, so let's meet our subject, E2E Networks. You've probably heard their name buzzing around if you follow India's tech space. But who are they really? What's the core business? Let's find out. In a nutshell, E2E Networks is smack in the middle of India's AI revolution. They call themselves an AI-first cloud platform, and they're a top domestic hyperscaler. All that means is they provide the massive computing power that AI needs to run. You can think of them as selling the digital picks and shovels during an AI gold rush. Their business model is something called Infrastructure as a Service, or IaaS. Basically, they own all the expensive, high-end computer hardware, and then they rent out access to it over the internet. So for their customers, it's a super flexible, pay-as-you-go model. You get world-class infrastructure without having to spend a fortune to build it yourself.
And if we dig a little deeper, their crown jewels are these things right here. Nvidia's advanced cloud GPUs. These are the chips that are the absolute engines of modern AI, and they are incredibly hard to get. What's so interesting, though, is their customer base. It's everyone from tiny AI startups to huge corporations and even major government projects. They're plugged into the entire Indian tech ecosystem.
So a good story is great, but professional investors demand proof. Now we get to the fun part, the financials. This is where we see if the cool story actually translates into a healthy, growing business. The numbers don't lie.
And wow, the numbers here are, well, they're staggering, frankly. Just look at their full-year results for fiscal 25. Revenue shot up 74%. EBITDA, which is a great way to look at a company's cash flow, more than doubled. And net profit, it soared 117%. I mean, this isn't just growth, this is hyper-growth.
But here's the thing that really gets an analyst excited. It's not just that they're growing fast, they're growing profitably. An EBITDA margin of 59% is, well, it's exceptional. It tells you this is a very efficient business with serious pricing power. For every dollar that comes in the door, a huge chunk of it is pure operational profit. That's the sign of a market leader.
And this isn't some old story. The most recent data we have, from Q3 of fiscal 26, shows that this insane momentum is still going. Revenue is up 68% from the same quarter last year, but look at the growth from the previous quarter, 60%. Things are actually accelerating.
Now this is a critical piece of the puzzle. Analysts who covered their last earnings call pointed this out. A massive government contract, the India AI mission, only started kicking in revenue at the very end of that quarter. So the full impact of that deal isn't even in these incredible numbers yet. That suggests there could be another huge wave of growth already baked in for the next quarter.
Okay, great story, fantastic numbers, but what does it all mean for the stock price? This is where we move from analysis to valuation and try to figure out what this thing is actually worth. So for a business like E2E that's pouring money into new computer hardware, that's called high CapEx, just looking at a P/E ratio can be really misleading. That's why analysts prefer a metric called EV to EBITDA. It's a bit of a mouthful, but it basically ignores non-cash accounting stuff and focuses on the pure cash-generating power of the business. It gives you a much cleaner look. All right, let's pop the hood on how this valuation actually works. This is an analyst's model from Dalal and Brocha. You can see they started by projecting future EBITDA, what the earnings will look like in a couple of years. Then they apply a multiple, in this case, 15 times. After that, you just adjust for the company's debt and cash to get to the final value for shareholders. It's a logical, transparent process.
And here's the final number that pops out of the model, a price target of 4,320 rupees. When this report came out, that implied a potential upside of, wait for it, 94%. This is what it's all about, taking all that research and boiling it down to a concrete, data-backed target.
But hold on. A professional analysis is never a one-way street. You have to be your own biggest critic. So now it's time for the reality check. What could go wrong here? What are the red flags?
And the risks are absolutely real. Analysts are watching a few key things. What if a major partner sells its shares? That could put a lot of pressure on the stock. You also have the global giants, Amazon and Microsoft, breathing down their necks. The big government contract could get delayed. And hey, this is tech. There's always the risk that some new invention comes along and changes the game completely. These are all things you have to watch.
Okay, we've looked at the business, the financials, the valuation, and the risks. It's time to put it all together. This is the final step, building the investment thesis.
You know, it really just comes down to two competing stories. The bull case, the optimistic view, is that this is the perfect company in the perfect market at the perfect time. A profitable, homegrown champion set to ride the AI wave. The bear case, on the other hand, says they face huge challenges, with massive global competitors and a dangerous reliance on government timelines.
So if you're interested in following this company yourself, here's an actual actionable checklist. Go read the company's own documents. Watch the quarterly numbers like a hawk, especially revenue and margins. Keep an ear to the ground for any news on that India AI mission. And of course, see what the competition is up to and watch who's buying and selling the stock.
And naturally, I have to say this. This whole breakdown is purely for educational purposes, just to show you how this kind of analysis is done. It is not and should not be taken as financial advice. All the info here is based on public data as of January 2026.
I'll leave you with one last thought to chew on. In a world where the hunger for AI power seems almost bottomless, maybe the biggest risk for a company like E2E isn't the competition. Maybe the biggest risk is simply being able to grow fast enough to capture this once-in-a-generation opportunity. It's a great problem to have, but it's still a huge challenge. Something to think about.